Welcome to Business Talk here on Business Tech, where today we're diving into the dynamic world of hedge funds. Now, for most of us, hedge funds may sound like something reserved for the financial elite, but that's certainly starting to change. I was looking at the ASISA figures. South Africa's unit trust industry stands currently at some 3.6 trillion rand, and hedge funds only make up about 151 billion of that value. So that's roughly 4%. I think one reason for the relatively low uptake of hedge funds is the perception that they might be for only the ultra high net worths and they might be too risky. While hedge funds do require more investment know-how, they have repeatedly and continuously proven their worth in the country as a really good uncorrelated part of a diversified portfolio. So with us today is Matthew Pouncett, a portfolio manager and analyst at Laurium Capital, one of South Africa's leading investment firms and hedge fund managers. Matthew's here just to peel back some of the layers on hedge funds for us and help us understand a little bit more about the asset class. Matthew, great to have you on the show.
Great. Thank you for having me. And good day to your listeners.
Now, before we dive into some of the specifics, let's start with a simple yet absolutely essential question. What is a hedge fund?
Yeah, it's a great question. And, broadly, there are many, many different types of hedge funds doing very different types of strategies. Today, I'll be discussing in particular what we call the long-short strategy. To unpack that, it's worth starting at what does a traditional asset manager do? We call that the long-only industry. So that's your normal equity fund or balance fund that many of your listeners will be used to. They can effectively only benefit from rising asset prices. So they take long positions. That's why we call it the long-only industry. And if asset prices fall, they will fall with it. If asset prices rise, they can rise with it. In a long-short hedge fund, we just have a lot more tools at our disposal to both increase return, but also to manage risk. And that most important tool that we speak about is the ability to short sell. So what does short selling mean? Effectively, we can benefit from falling asset prices. So if you own a particular share, I can borrow that share from you. I sell that on the open market. I sell it on the stock exchange. I generate cash. Now I have a liability to you to return that share at a later date. And the view is if that share price falls, I'm going to buy it back at a lower price. I would have banked a profit and I can return that share to you. So if you sort of just want to make a very simple example, if you have a long-only equity fund and you give that fund manager 100 Rand, they'll go out and find the best securities that they like, that they think will outperform the market. And that's pretty much all they can do, right? And we can do very much the same. But in addition, we can short sell. So we have this 100 Rand long book, but we can also then short, let's say, 50 Rand of shares that we don't think are particularly attractive or that we think will underperform that long book. And what you left there is 150 Rand of, let's say, money-making positions. All right. In the industry, we refer to that as gross exposure. So that's the absolute sum of your long book, the 100 Rand, and the short book, the 50 Rand. That's 150 Rand. But I'm also now only 50 Rand net exposed to the market because I've got 100 Rand of positions that will benefit from the market going up, but I've also got 50 Rand positions that will benefit from the market going down. So what we've done there is we've effectively reduced our overall market exposure by about half, and that we call our net exposure. So you'll hear that word a lot in the hedge fund jargon. Net exposure really refers to your long book minus your short book, and it's your overall market exposure. So the idea there, Michael, is that we've got greater scope to generate return from that 150 Rand of gross exposure or ideas, but we're doing it through actually only accessing about 50% of that market risk. And that's why over time, if your manager is selecting securities correctly, you'll get the dynamic that you will earn better return for unit of volatility. So share prices, your returns will be smoother, they'll be less volatile, and you'll also experience less drawdowns. So when the markets fall, sort of steeply, you won't necessarily capture that full drawdown over the life of your investment in that portfolio. So that's really what a hedge fund does. So it just gives you greater scope to kind of exploit ideas within the market. So we can do things like pair trades. So let's say, for example, you have, two banks that operate in the same sector. They're very much exposed to the same risk factors, the same macro factors. You can, take a position in one particular bank that you think is attractive. You can short another share that you don't think is attractive. And if they converge, if those prices converge, you're making profit there, but you've done so without taking on net banking exposure in your portfolio. So, let's say, for example, there's a large scale domestic sell-off, or both positions will kind of correlate quite nicely. So you won't necessarily feel that full market drawdown. So that's really the idea. I mean, we always talk about it as more tools in the toolbox, and we have a very flexible mandate.
Yeah, and I often hear the word risk-adjusted return and
Yes.
smoothing that volatility, and for good reason. I mean, if you look at a lot of the data, the Alex Forbes Fund Manager Watch, and all of the data, when it points to who are the managers that are outperforming, it's those that deliver that smoother ride, because we're human beings as investors. At the end of the day, when markets fall precipitously, our knee jerk is to want to pick up the phone to our broker or consultant or fund manager and say sell, and that's the worst thing you can do. So if you can smooth that journey out, you're actually helping cushion against our internal emotional biases and tendencies to make knee jerk responses. Now, while hedge funds have historically only been available to institutions and high net worth investors, we have seen some regulatory shifts, and retail investor hedge funds have made this a lot more accessible. Why is it important for hedge funds to be democratized in this way? And maybe you could just talk me through that change and evolution, because I still think you need to have some sophistication as an investor to be investing in the asset class.
It's a great question. So South Africa is actually quite unique, having this sort of retail class of hedge funds, right? We call it the retail investor hedge fund category. RIFs is the jargon that people refer to. And effectively what that does is it puts up some guardrails on your manager, right? So typically hedge funds don't have any mandate limits. So if you're thinking globally, hedge funds, the idea is that you want max flexibility. You don't want to be constrained anyway. So the mandates are very loose in terms of what they direct the manager to do, right? If you think of a long-only manager, there's lots of guardrails, right? There's sort of caps that they can only be 100% invested. They can't be more invested than that. They can't leverage up the fund. They've got to keep their investments to a certain type of asset class. They've got to keep it to a certain type of liquidity. Hedge funds, you don't have that. So if you look globally, and what I referred to earlier was this sort of wide array of different hedge funds that you have, it's because of that flexibility, right? So some funds will be taking on massive amounts of leverage, very esoteric instruments. Others might hold quite a substantial amount of unlisted assets, so almost private equity, mixing private equity with public equity. And that makes it very difficult for the average investor to access those portfolios, because as you rightly say, you need a level of sophistication and risk tolerance and understanding to be comfortable with investing in that. What we've done in SA is we've said, well, let's create a sort of category of hedge funds that do have some guardrails, right? So we cap the gross exposure of those funds at 200%. So gross being the longs plus your shorts in absolute terms. That's capped at 200%. You've got to have monthly liquidity in your portfolio, so you can't own unlisted assets. There are mandate limits on your maximum position sizes per security. So effectively, it kind of brings the hedge fund universe in South Africa under the unit trust world, right? I mean, and that's effectively what these are. They are unit trusts. RIFs are unit trusts. They're under the SISCA framework, Collective Investment Scheme framework. So what that's done is it's put up some guardrails. It's made it a lot more easier for an investor to understand what's happening in that fund. Because I always make this point, in the South African context, we're very vanilla in terms of the hedge fund strategies that we run. And I'm referring to Laurium, but I'm also referring to our peers. We don't do esoteric instruments. We don't do unlisted assets. Our gross exposure, our leverage is very moderate. Most funds are sitting at about 130, 140%. So we're in that frame of operating in any case. So they were quite adaptable to this new unit trust world. So they've simplified hedge funds. It's made it very easy to access. And why is it important? You mentioned earlier, we're a very small part of the market. We're sort of 3-4% of, as you mentioned, of the unit trust universe. So we're quite unique. We're operating in a market where, because of that kind of small size, a lot of hedge fund type trades don't have a lot of competition. So it's a very good market for hedge funds to operate in, because we still have a very small piece of the pie. So the net effect, as you rightly said, is that hedge funds have delivered better risk-adjusted returns over time. So there's a sort of a use case there. Also, the thing about hedge funds to consider is that they're very adaptable. And depending on the type of long-short strategy that you're running, they can be used for growth portfolios. So, pre-retirement type of long-term savings, or, the lower kind of risk, lower heartbeat funds are very well adapted to annuity portfolios, creating a smoother return profile. So there's quite a lot of use cases for hedge funds in different portfolios. And as I say, sort of the track records are very positive. So I think it's a great step that we've taken to sort of, as I like the way you termed that, democratize the hedge fund universe.
I still think there's a lot of myth around hedge funds. And listen, there is globally, I mean, there have been examples of hedge funds that were kind of way over levered and blew up spectacularly through various financial crises that really added external stresses via black swan events like the global financial crisis, for example. So let's just debunk a few myths. What do people most often misunderstand about hedge funds, Matthew? When you at a dinner party, you're at the Bri over the weekend watching the Box win yet another game, and you say, well, this is what I do. And they say, oh, hedge funds, and this is what they are. And they're completely incorrect.
Yes. So I suppose the main kind of stereotype is that they're a black box. There's no way of really understanding what comes out of them, that managers are swinging the bat, if you like, using a lot of leverage, using complicated derivatives, and taking excessive risk. They're often seen as being risky funds. And that's probably the greatest, false view, because in effect, they're actually the opposite. We're using that ability to short sell, not to increase risk, but to actually reduce risk. It's a risk reducing tool. So the idea is actually that we're not as risky as a typical equity fund, for example. And as I said earlier, in the South African context, we're quite vanilla. There's no esoteric derivatives or, wild and fancy instruments that we're using. It's all pretty straightforward and vanilla.
Now, when you look at the hedge fund universe, obviously, it requires a highly active management approach from the manager, and that must clearly come with a fee structure that is slightly different from, say, a vanilla Satrix 40 ETF, for example, or just a traditional unit trust. Can you tell me a little bit more about how the fee structures are packaged in the hedge fund universe?
Right. So the biggest difference probably, versus the long-only industries, we have a much greater tilt towards a performance fee model. So, the management fees are broadly about the same in South Africa between the two, but we have a performance fee model that, during periods of very, very good outperformance, the manager will share a significant portion of that performance fee. So over time, what you will find is that hedge funds do have a higher performance fee and therefore a higher fee element to them. The total expense ratios, as the industry refers, will be higher than your traditional fund. In saying that, all the returns that are quoted and these risk-adjusted results are all net of fees, of course, And really the idea is that you only really take fees when you've done very well, when you've performed and delivered value to the client. That's when the performance fee element comes in. So the manager that is not performing well will not take high performance fees. The other element that's really important and kind of unrecognized is that we have something called a high watermark. And what that refers to is that over the full life of the fund, if you hit a certain level of return, but then you go backwards, you've got to reclaim that prior level that you hit, that prior level of NAV, before you then take performance fees. Now, that's very different to the long-only industry, which uses a rolling performance fee calculation. So you can actually invest in a long-only manager that underperforms the benchmark over 5 years, but during that 5-year period, you would have paid performance fees because they're going to be rolling in and out of different return sequences. In the hedge funds, you can't really do that. If we go back 10%, or we've got to reclaim that for, we were able to take any fees. So that really, what it does is it emphasizes trying to protect the downside for the client. So, the fees is a major stumbling block in the industry. I think we're sort of very clear on that. They are higher over time, but the idea is that they're only higher if the outcomes are appropriate.
And again, I think there's a misconception that you've helped dispel around fees as well. And I get that in the private equity industry as well. Yes, the 2 and 20 model has come down a little bit and may have been a little bit out of kilter with what's fair, but you want to be paying for outperformance, and you wouldn't underpay to go see the best specialist for your health, for example. So if you're getting that value and the value is aligned, I certainly don't see a problem with that. Now, there is dispersion, though, I must say. If you look at some of the manager rankings, even though it's a small industry, the top managers really do outperform consistently, and Laurium is definitely one of the top managers. So could you just unpack the different hedge funds that Laurium Capital offers and the type of investor that each one is targeted at?
Yeah, so we have 3 hedge funds. All of them have track records of longer than 10 years. And really, if you think of them on kind of a risk-return spectrum, our lowest risk fund is something which we call the market neutral, which, as the name suggests, takes very little net market exposure. So we almost offset our entire long book with short positions. And really what we're trying to do there is just attract kind of the alpha element of our stock picking. And the result there is that you have lower levels of volatility and actually very low levels of correlation with other asset classes, because the return and the risk of that fund is totally idiosyncratic. That fund, Michael, is very well suited to annuity portfolios, for example, where you're trying to create kind of returns above CPI, returns above cash, but you don't want the full kind of volatility of the market. And you're also trying to reduce correlation with everything else in the portfolio. Then we have our long short fund, which runs very much like the example that I mentioned earlier, where we're about 100% long, 50 Rand short. That's kind of in the middle. And then we have a fund called the Enhanced Growth, which runs very much with a structural net long view. So we run with a fair amount of market exposure in that fund. And really what we're trying to do there is get equity-like returns. We're actually trying to beat CPI plus 10. That's kind of the target. That fund's outperformed equity market quite substantially over time. And that's very much adaptable and suitable for, let's say, pre-retirement portfolios where you're happy to take some level of volatility, but you're really just trying to boost your equity allocation and get higher returns. So, like I mentioned earlier, there's quite a lot of, by sort of altering those net levels that we run at, you can really adapt portfolios for different use cases.
That's certainly where I would be positioning my portfolio versus the market neutral, which is probably where my mom's annuity should be sitting at the moment. She's 72 now. I know hedge funds often look for the opportunistic approach in an emerging market like South Africa. Timing is everything, and when you decide to swim against the current, because with all of the moving parts, Donald Trump 2.0, tariffs, taxes, is China going to stimulate? What's going to happen in the geopolitical sphere? I mean, there's so much uncertainty at the moment. How do you go about doing that?
So as a sort of core principle, what we're trying to do is not be as directional as your typical long-only fund. So, what we're actually trying to do is reduce what we call that factor risk, right? So the Rand, interest rates, currency. We're actually trying to take all of those factors that you typically pick up when you establish a long position in the market. We're actually trying to reduce those. So really the idea is we're trying to eliminate as much of that as we can. Now, you can't eliminate all of it because then you won't make any return if you take no risk. But you're trying to actually dampen your exposure to those types of ups and downs And really what you're trying to do is go more at a stock specific level and trying to find risk pricings almost relative, within sectors. So that's kind of the core principle. But when you're establishing a portfolio, the kind of main thing is to understand when you're selecting positions, do you have some form of advantage? And that's a key thing to understand. Now sometimes that's an analytical advantage or information advantage. Now, that's very difficult in very liquid markets. So to sort of gain an edge on your Microsoft analysis, very difficult. It's covered by more than probably 50 sell-side analysts whose livelihood it is to analyze Microsoft every day. You're not really going to gain an analytical edge on that. But as you fall down the market cap spectrum, and especially in the local market, if you're looking at kind of that mid and smaller cap universe, that's not as well covered. It doesn't get as much attention from the big, large asset managers in South Africa. And often there is ability there to use, an analytical advantage. The other advantage is often liquidity. Your best trades, your best purchases will always be from a distressed seller. So that's the main benefit of a hedge fund as well. That's kind of not appreciated fully, is that we're always sitting on a ready cash pile. So like my earlier example where we were only 50 Rand net exposed to the market, well, the other 50 Rand is sitting in cash. So, and we can deploy that very, very easily and quickly. And that means that we always have liquidity. A long only fund often doesn't because it's fully invested. So sometimes it's a liquidity advantage. Sometimes it's structural. Often what we see in South Africa is sort of a little bit off the beaten track instruments like preference shares or distressed debt. There's no natural buyer of those type of opportunities in South Africa. So there's almost like a structural shortage of buyers sort of fall through the cracks. And because we've got a little bit more of a flexible mandate where, although we're chasing equity-like returns, we can invest in non-equity instruments. We can establish positions in those. So the key thing always when you're looking at a portfolio or a position is to understand, do I have an advantage here in trying to really get alpha? So that's not easy.
Yeah, but those are some pretty important tactical advantages, particularly if there's a market drawdown, to be able to sit on that cash and to be agile enough to be able to exploit an opportunity. The Rand, though, I mean, it's volatile. It's the rattler for a reason. I was in Ireland recently. We put money in our Forex card at 19.20 to the euro. It strengthened to 18.80 while we're there. It's now back to 19.30. How do you navigate that kind of challenge of the currency? Do they create more challenges or unique opportunities for you?
It's a great question, and especially in the South African equity market context. I mean, we basically are two worlds in our market. So we have what we call the Rand hedge world. So that's a lot of the global companies that are listed here almost out of legacy. So stocks like Anheuser-Busch, British American Tobacco, they've got very little, if nothing, to do with South Africa, but they're listed here and they're pretty much international. You have the mining companies, which, although maybe you have operations in South Africa, some of them, they operate in a dollarized world. They're selling a dollarized commodity. So that behaves in a very different way to what we call SA Inc. Your often managers refer to this idea of SA Inc. What that refers to is the domestic orientated companies that are listed on the JSE. So banks, retailers, the industrial companies, they very much depend on what's happening here locally. So you've almost got these two different markets and they behave and they go in very different directions. So you really have to think about that when you're establishing a portfolio of longs and shorts, that you're not doubling up on risk. So let's say, for example, I was long South African banks, but short gold companies, okay? If the Rand weakens, my banking shares are likely to go down, and the gold shares that I'm short are likely to go up. And actually, my two books are going to be going in different directions, which is exactly what you don't want. So what we typically look like when we're establishing a short book is how correlated is it to my long positions. And it's going back to the earlier point that I made, where you're trying to actually reduce these factor exposures like the Rand and Trump and interest rates through your short book. You're not trying to double up on them. So it's a great question. What you don't want is your portfolio to inadvertently become a big Rand bet, because that can actually happen relatively easily if you're not considering this factor.
It's a really fascinating world. So just in summation, I mean, if you were to give some advice to a South African investor or even an organization interested in investing in a hedge fund, if you've maybe been sitting on the fence, but you're looking now to get started, what should they know? Where's a good place to start?
Yeah, so the great thing about South Africa is because of this RIF framework, the results of the hedge fund managers are all fairly public. You know, you can kind of go onto websites, you can kind of go onto the platforms and download the monthly return profiles of a lot of hedge funds. And a lot of us have been around for a decent amount of time. We've kind of been around through the GFC, through COVID, etc. So there's long track records that have been established. So the information actually is available, which is very different to global, where, you know, hedge funds kind of, sit behind a veil and you sort of need to really knock on the door and ask for the performance to get it. So it is freely available. So, one can really kind of look at the track record of that manager, how they behaved, but it does take more due diligence. You're 100% right. Because we're kind of all very different. The hedge funds here, we all got a very different style, a very different way of operating. You mentioned the dispersion earlier. We're going to have different performance signatures over different time periods. It is important to kind of understand, what does the manager actually do? Are they more globally orientated, or are they more locally orientated? Do they run high growth? Do they run low growth? So there is certainly, despite the democratization, a little bit more kind of due diligence required. But the important thing is that the information is kind of there and it's freely available. So we've done quite a lot of sessions with IFAs and with the discretionary fund managers, the guys that compile portfolios on behalf of financial advisors. So there definitely is a growing understanding of hedge funds, and it's debunking those myths that you spoke to earlier.
Yeah, well, it's not a black box like the private equity industry is. And I often take Savco on about this because they publish their survey, assets under management, deal activity, but they never publish performance. And I say to them, guys, I know you're the private equity industry. You don't have to disclose anything else, but we need to improve that disclosure. Whereas the hedge fund industry certainly has done that, and I think it really a welcome addition. Well, there you have it, the long and the short of the hedge fund industry with Matthew Pouncett here on Business Talk on businesstech.co.za. Matthew, thanks so much for your time.
Great. Thank you, Michael.